For over 80 years, one currency has ruled the global economy. It backed oil, it backed gold, it financed wars and shaped empires. But what if starting tomorrow, all of that changed? What if the US dollar fell? Imagine waking up one morning and realizing that the money in your bank account suddenly buys less. Not because of inflation, not because of a market crash, but because the world simply stopped trusting the US dollar. Today, we're exploring what would happen if the US dollar lost its global throne. The US dollar didn't just become the world's most powerful currency by accident. Its rise was deliberate, strategic, and for decades unstoppable. It all started in 1944 at a hotel in Bretton Woods, New Hampshire. As World War II was nearing its end, 44 allied nations gathered to rewrite the rules of global finance. The result? A system where all major currencies were pegged to the US dollar and the dollar itself was backed by gold at $35 an ounce. This agreement gave the US a central role in the global economy, and other nations gladly accepted it. America had the largest gold reserves, the most industrial power, and had just emerged from the war with its infrastructure intact. But everything changed in 1971 when President Nixon ended the dollar's convertibility to gold. The world panicked, but only briefly, because a new system quickly took its place: the petrodollar. The US struck deals with oil-rich countries, especially Saudi Arabia, to sell oil only in US dollars. That one move re-cemented dollar dominance. Today, over 80% of global oil sales are still done in US dollars. But it wasn't just about oil. Over time, the world started holding dollars for everything: reserves, debt, trade. The dollar became the bedrock of global finance. Why? Because people trusted the US economy. A strong military, legal protections, deep capital markets, it all created confidence. This gave the US a major advantage economists call exorbitant privilege. America could borrow more, pay less, buy goods cheaply because the world needed its dollars. And for decades, the dominance of the US dollar in global finance has been treated as a fact of life. Countries borrow and lend in dollars. Central banks around the world stockpile US Treasury bonds like savings accounts. But today, that once unshakable status is starting to crack, not because of a single event, but due to a quiet, accelerating shift in global trust. And if you follow the signs closely, the message is clear. A growing number of countries no longer want to rely on the dollar. One of the most pressing concerns for these countries is the state of America's finances. The US national debt recently passed $37 trillion, a number so large it's hard to even comprehend. And it's not just the size of the debt that worries investors and foreign governments, it's the dysfunction surrounding it. In recent years, the US has come dangerously close to defaulting on its own obligations, not because it couldn't pay, but because of political gridlock. The spectacle of debt ceiling negotiations, where lawmakers argue over whether to authorize spending that's already occurred, is becoming routine. What message does that send to the rest of the world? That the US can't be trusted to manage its own books. But there's something even more worrying to other governments: the way the US uses the dollar as a weapon. In global conflicts, sanctions have become one of Washington's most powerful tools. And the most effective sanctions are financial. When the US imposes sanctions, it can block countries from accessing the global banking system, especially the SWIFT network, which connects thousands of financial institutions worldwide. That's exactly what happened to Russia after its invasion of Ukraine, and to Iran long before that. These nations were effectively locked out of the dollar-based economy. Their dollar reserves were frozen. Their companies couldn't make cross-border payments. Whether or not the sanctions were justified, one thing became clear: the US has the power to freeze entire economies at will. That power makes the dollar look dangerous to anyone who might one day fall out of favor with Washington. That's why many countries, not just America's rivals, but also its partners, are quietly rethinking their dependence on the dollar. This movement is most visible in the actions of the BRICS nations: Brazil, Russia, India, China, and South Africa.
These 5 countries represent more than 40% of the world's population and over a quarter of global GDP, and they made it clear they want alternatives. Russia, facing sanctions, began trading oil and gas in rubles and yuan. India, which traditionally settled nearly all international energy purchases in dollars, signed a deal with the UAE to pay for oil in rupees, a major shift in the global payment landscape. Meanwhile, China took an even bigger step. In 2024, China bought crude oil from Saudi Arabia and paid in yuan, ending a 50-year-long tradition of pricing oil exclusively in dollars. This wasn't a minor technical adjustment, it was a geopolitical statement. And it didn't stop there. Even France, a core EU country and a US ally, finalized a liquefied natural gas deal with China and paid in yuan. It was the first time a Eurozone nation had used the Chinese currency to pay for energy. These moves may seem small on their own, but taken together, they mark a pattern. The world is slowly building parallel systems, step by step, to reduce reliance on the dollar. Central banks are responding too. In the past, they would accumulate US dollars in treasuries as a sign of safety, but now many are diversifying. Instead of buying more US debt, they're buying gold, and in record amounts. In 2023 alone, central bank gold purchases reached an all-time high. But why gold? Because it's no one's liability. It can't be frozen by sanctions or manipulated by foreign central banks. It's a timeless hedge against instability. And central banks increasingly don't see US treasuries that way. All of this has fueled a global conversation that was once fringe but now mainstream.
De-dollarization. In Latin America, Africa, and Southeast Asia, the so-called Global South, governments are asking why their economies should depend on decisions made in Washington. If your country has nothing to do with US politics, why should your currency reserves, your debt, and your trade flows be tied to the dollar? And here's where things get more experimental and more ambitious. Technology is now giving countries new ways to move money across borders without the dollar. Over 100 nations are currently researching or developing central bank digital currencies, or CBDCs, programmable, state-backed versions of traditional currency. China is leading the way. Its digital yuan has already been used in cross-border payments with Thailand and the UAE. These new digital rails could eventually form the backbone of a financial system where the dollar isn't necessary. The BRICS nations have also discussed launching a common settlement currency, potentially backed by a mix of commodities or local currencies. The idea is still in its early stages and unlikely to proceed because of concerns over greatly unequal influence among members. But the direction is clear. They want an escape hatch, a parallel path, a new way to trade, save, and lend without relying on the US dollar. But still, there's no clear replacement. The Chinese yuan, despite being Beijing's ambitions, is tightly controlled and not freely convertible. The euro suffers from political fragmentation and a lack of fiscal unity across member states. And the BRICS currency remains theoretical and controversial, more of a signal than a functioning alternative. And for the first time in decades, the question isn't if the world can live without the dollar, it's how soon it might decide to try. But what happens if the dollar loses its throne? Well, the first domino to fall would be a global sell-off of US assets, starting with treasury bonds. Countries like China, Japan, and Saudi Arabia currently hold over $2 trillion combined in US debt. If they begin dumping these holdings, the bond market reacts violently. Prices crash, yields spike. Suddenly, the US must offer much higher interest just to attract buyers, making it exponentially more expensive to fund government spending. That's not just a Washington problem. When Treasury yields rise, interest rates across the board go up with them. That means mortgage rates, the interest you pay on your home loan, could soar. Credit card APRs, the cost of carrying a balance month to month, would surge. Small businesses would face much higher borrowing costs to expand, hire, or even survive. In simple terms, the price of using someone else's money, whether you're buying a home, funding a startup, or just paying your bills, would become painfully expensive, guaranteeing economic contraction. At the same time, a weaker dollar begins to erode purchasing power. The U.S. imports over $3 trillion worth of goods annually, everything from consumer electronics to industrial machinery. If the dollar falls, every single import becomes more expensive. That means inflation. Not the post-pandemic kind we saw in 2021 to 22, but something deeper, structural. But this isn't just about spreadsheets. It's about your wallet. In real terms, the dollars you already have will be able to buy much less. And then there's the psychological blow. The loss of global trust in the dollar doesn't just affect the economy, it undermines America's geopolitical leverage. The ability to impose sanctions, influence trade flows, and shape international financial rules is all tied to the dollar's dominance. Without that dominance, the U.S. loses one of its most powerful tools. For emerging markets, the shift is just as dangerous. Many developing countries hold large amounts of dollar-denominated debt. If the greenback suddenly collapses in demand, it could spark a wave of financial instability as countries struggle to refinance their obligations in an uncertain market. And trade it fractures. Rather than a unified global economy built around one currency, we could see the rise of currency blocks, the yuan zone, the euro bloc, even a BRICS token area. Each region trading within itself, reducing interdependence and increasing friction. Back home, life becomes harder. Groceries, gas, medicine, all more expensive. The cost of living shoots up. Meanwhile, America's military and diplomatic strength may start to feel diluted, not because of a sudden war, but because the quiet foundation of economic trust begins to crack. Finally, the stock market, long a symbol of America's financial supremacy, starts to look less appealing to foreign capital. As investors move their money elsewhere or keep it at home, volatility spikes and market corrections become more frequent. So, if the dollar truly loses its global throne, everyday life in the U.S. would change, perhaps slowly, but significantly. So far, everything we've shown might make it seem like the dollar's fall is inevitable and imminent, but the reality is more complicated. Even though confidence in the dollar is being challenged like never before, its collapse as the world's reserve currency won't happen overnight. Despite all the growing cracks, the dollar is deeply embedded in the foundations of the global economy. Let's start with the numbers. As of early 2025, the US dollar still makes up around 59% of global foreign exchange reserves. That's down from about 70% 2 years ago, but it's still more than double the euro share, which sits around 20%, and far ahead of the Chinese yuan, which holds just about 3% of reserves worldwide. So, to put this into perspective, central banks across the world still hold over $6 trillion worth of US dollars in reserves. And to be clear, holders of US treasuries don't want the dollar to collapse either. These are funds used to stabilize exchange rates, settle international payments, and back government debt. Why do they still hold so much in dollars? Because no other currency comes close in terms of liquidity, trust, and access to global markets. The euro, for instance, once seemed like a real contender. When it launched in 1999, many expected it to challenge the dollar's dominance. And in some areas, it did. It became the second most used currency in trade and finance. But it has never fulfilled its full potential because the Eurozone is politically fragmented. Unlike the US, Europe lacks a single unified treasury or common fiscal policy. That means when crises hit, like the 2011 sovereign debt crisis, the euro can't respond as flexibly or as forcibly as the dollar. Then there's the Chinese yuan. China is now the world's second largest economy, and it's aggressively pushing to internationalize its currency. It struck deals with Russia, Brazil, Saudi Arabia, and others to use yuan in cross-border trade. But the yuan has a major flaw. It's not fully convertible. Beijing tightly controls capital flows in and out of the country.
That makes investors nervous. They can't move money freely or trust the Chinese legal system to protect their assets in the same way as they can in the US. Trust is everything in the financial world. And despite America's rising debt and political dysfunction, global markets still trust the US system. Or at least, they trust it more than the alternatives. But beyond trust, there's another reason the dollar isn't going away tomorrow.
It's woven into the machinery of global finance. Take SWIFT, the global messaging system used by more than 11,000 banks worldwide to settle payments. The vast majority of SWIFT transactions are still denominated in dollars. Then there's the energy market. Most global oil contracts, whether it's crude from Saudi Arabia, natural gas from the US, or liquefied natural gas from Qatar, are still priced and settled in dollars. As we already mentioned, this petrodollar system has been in place since the 1970s, when the US struck a deal with Saudi Arabia to price oil exclusively in dollars. That deal made the dollar indispensable. And yes, even when France bought liquefied natural gas from China in yuan in 2023, it was the exception, not the rule. So yes, de-dollarization is happening. It's real. It's being talked about at BRIC summits and in central banks from Brazil to Beijing. But dismantling an economic system that took 80 years to build is not a weekend job. It's a process that will take decades, not days. Just like an aircraft carrier can't make a sharp turn, the global monetary system doesn't pivot quickly. Momentum matters. Inertia matters. And for now, the dollar still has both on its side. But still, whenever there's talk about the US dollar losing its dominance, one fear rises above all: hyperinflation. The word alone brings to mind images of people wheeling barrels of worthless cash to buy bread like Germany in the 1920s, or more recently, Venezuela and Zimbabwe. But could that really happen in the US? Could the dollar collapse in such a dramatic and devastating way? Let's be clear, the risk is not zero, but it's extremely low unless several unlikely but dangerous factors all align. The first red flag would be massive, uncontrolled money printing. When a government prints too much money without a corresponding increase in goods and services, it drives prices up. That's inflation. When it spirals completely out of control, you get hyperinflation. The Federal Reserve did increase the money supply rapidly during the CO9 pandemic to stabilize the economy. But since then, it has reversed course, raising interest rates and shrinking its balance sheet. As of August 2025, inflation in the U.S. has cooled significantly from its 2022-2023 highs, with year-over-year CPI growth now under 3.2%, well below the double-digit peaks of the crisis. Hyperinflation would only become likely if the U.S. completely lost fiscal discipline, for example, running even larger deficits and choosing to fund them entirely by printing money instead of borrowing. So far, that's not happening. The second possible trigger is global rejection of dollar assets, meaning other countries dump U.S. treasuries, abandon the dollar in trade, and refuse to lend to the U.S. government. If trust in dollar-denominated assets collapsed overnight, the Federal Reserve would face an impossible choice: raise interest rates to extreme levels to stop capital flight, or print more dollars to cover the shortfall, either of which could destabilize the economy. But again, this is highly unlikely because there is still no global alternative with the size, depth, and trust to fully replace the dollar. Another tipping point would be the loss of Federal Reserve independence. Right now, the Fed operates with a degree of autonomy from political interference. That allows it to focus on long-term economic stability. But if political forces began demanding that the Fed fund spending or suppress interest rates for electoral gain, it could lead to dangerous monetary distortions. That's the path countries like Argentina and Turkey have walked, and it rarely ends well. So how likely is this black swan event? Most economists agree, very unlikely in the short term. The U.S. still has strong institutions, deep capital markets, and the benefit of the doubt. But fear remains, and not without reason. In uncertain times, even remote possibilities feel more real. That's why central banks from China to Poland have been buying record amounts of gold, not because they expect collapse tomorrow, but because they're hedging against a world that no longer runs on automatic trust in the dollar. The black swan isn't here yet, but the world is building lifeboats just in case. In the end, we can conclude that the collapse of the dollar won't happen overnight, but its dominance is quietly eroding. The shift is slow but real. A world with multiple currencies, rising risks, and fading privilege is already taking shape. The U.S. is losing more than just a currency advantage. It's losing leverage, stability, and the luxury of unchecked debt.